Markets don't just move in straight lines. Prices fluctuate, creating opportunities for traders to profit from short to medium-term price swings. This is the essence of swing trading, a strategy designed to capture these movements and maximize returns. Let's explore how it works. Swing trading is a trading strategy that aims to profit from short to medium-term price movements within a trend. Unlike day traders, who close positions within the same day, swing traders hold trades for several days or even weeks. How swing trading works. Swing traders aim to capture price swings between support and resistance levels, benefiting from both upward and downward movements. The key is to enter trades when the price is likely to reverse and exit before the momentum shifts. Key tools for swing trading. To improve accuracy, swing traders use technical indicators to identify trade setups. Here are 3 essential tools. Moving averages. Moving averages help traders identify trends. When a short-term moving average crosses above a long-term moving average, it signals a buying opportunity. A crossover below signals a potential sell. Relative Strength Index, RSI. RSI helps traders spot overbought and oversold conditions. A reading above 70 suggests the asset might be overbought and due for a pullback, while a reading below 30 indicates an oversold condition, signaling a possible buy opportunity. Support and resistance levels. Support and resistance levels help traders determine entry and exit points. Buying near support and selling near resistance is a common swing trading strategy. How to execute a swing trade. Step 1. Identify the trend. Determine the market trend. Swing traders follow both upward and downward trends, looking for opportunities within these movements. Step 2. Wait for a pullback. Instead of chasing price movements, swing traders wait for a pullback, a temporary reversal before the price continues in the main trend. Step 3. Enter the trade. Once the price reaches a key level, traders enter the trade based on confirmation from indicators like RSI or moving averages. Step 4. Set stop loss and take profit levels. To manage risk, traders set a stop loss below recent lows and a take profit at the next resistance level to secure gains. Common swing trading mistakes. Many beginners make common mistakes, such as entering trades without confirmation, ignoring risk management, or holding positions for too long. Always follow a structured approach and make sure to check swap rates using the specification feature on an asset. Combined with technical tools, swing trading offers great opportunities for traders who want to improve their success in the markets. Want to learn more trading strategies? Subscribe for more videos and check out our platform for real-time market analysis.